everyone for joining. There are going to be 4 parts to today's session. First, we'll take a look at the lay of the land in financial markets for corporates. Then I'll turn to some near-term concerns, including the Fed tapering, the rapidly approaching debt ceiling, and we'll discuss some metrics that are useful in assessing the amount of angst in financial markets, and one of them is the EBS. And then I'll finish by discussing the economic and financial implications of breaching the debt ceiling. Don't worry, I'll still find a way to end on a positive note after going through that Armageddon scenario. Before diving in, I want to give you the key takeaway, and that is the best times are behind us. Interest rates are set to rise, growth in the economy has peaked, corporate profits, earnings growth is going to moderate, and defaults are going to rise, albeit from very low levels. Even though these good times are behind us, conditions are going to still remain very favorable as the scarring from the pandemic recession appears to be very limited, and we're still in the early stages of what hopefully will be a long economic expansion. So let's start with part 1, the lay of the land. There's a growing concern about the health of American corporates. Corporate bond issuance last year was very, very robust. It's very strong this year. Corporate leverage is rising. And all this is okay in an environment with low interest rates, and this is why one section of today's conversation is going to be about the prospect of the Fed tapering and avoiding another taper tantrum, because as interest rates rise, that's going to put some pressure on corporations to finance the amount of debt that they've taken out over the last couple of years. But there's plenty of reason for optimism, and that's what's being shown in the first chart. The stock market has rallied significantly since its post-pandemic lows, but along with that, corporate profits have also surged, and they've been much stronger than what we've seen overall with nominal GDP. And corporate profit margins remain very wide, and that's encouraging, given that we're in the midst of a period of transitory inflation. Consumer prices, producer prices, import prices have all accelerated quite noticeably since the start of this year. But with corporate profit margins wide, companies can digest some of those higher input costs while passing some on to you and I. And the other thing with corporate profits being as strong as they are, and interest rates still at historic lows, that kind of justifies the valuations that you're seeing in the stock market, which kind of hopefully insulates us from a near-term correction. Now, a correction will occur at some point. On average, a 10% decline in the stock market occurs once every 2 years. That's on average since the 1970s. And if you see what's going on in equity markets recently, the volatility has picked up, and a lot of that is attributed to monetary policy, not just by the Federal Reserve, but also internationally. Some developed central banks are turning a little bit more hawkish, and that's leading markets to start to price in a little bit more aggressive tightening cycle among central banks. And then there's also the debt ceiling. But hopefully, once we're on the other side of the debt ceiling, with an economy that we forecast to grow roughly 6% this year, 4% next year, and interest rates that are going to only steadily rise, that's digestible for financial markets. Therefore, we anticipate still solid corporate earnings growth, profit growth of 5% next year, and that should keep financial market conditions very favorable for the broader economy, and also ease or limit the amount of credit risk or credit concerns among investors. This recession was unlike any that we've seen before. It was the deepest recession on record, but also the shortest. And that is a very unique combination. We avoided the depression. There's the 3 Ds of the depression. There's the depth, which this recession met. There's the deflation aspect, which didn't occur, and duration. This was a very short recession, and it helped The short nature, along with the very aggressive policy response, limits the impact on defaults, delinquencies. You can see that in this chart here. There was a disproportionate effect of the recession on investment grade and high yield. You can see the number of downgrades, which is the blue bar, jumped in 2020. But if you have to squint to see an increase in investment grade defaults. Now, downgrades did increase, but nowhere near what we saw during the financial crisis. There was an increase in high yield defaults. But if you fast forward to this year, all these metrics have improved quite noticeably. The number of downgrades is still less than the number of upgrades for high yield investment grade. The number of defaults for investment grade and high yield have both come down. And this is kind of the sweet spot of this credit cycle. Going forward, and this is what you'll start to see in the EDF data over the next 12 to 18 months, is that with a steady increase in interest rates, there's some slowing in the economic activity, a little bit tighter financial market conditions because they've been very, very loose over the last year and a half. Conditions are going to get a little tougher. It doesn't mean that corporate bond issuance is going to fall off a cliff. It doesn't mean we're going to see significant increases in the number of investment grade or high yield defaults. We're just going to be on the other side of the sweet spot, and conditions will get a little bit more challenging, but nothing that you would raise a red flag. So on the next slide, investors' perception of credit risk remains, very good. There's not a lot of concern about credit risk. And you can see that in the high yield corporate bond spread, which is the blue line on the left-hand scale. And it's very tight from a historical perspective. On average, the high yield corporate bond spread averages about 500 basis points. We're right around 300 basis points currently. In the last week or so, there's some concerns about a Chinese developer that rattles financial markets, but you have to squint to see the impact on U.S. high yield corporate bond spreads, which I think is encouraging that this is being viewed more as an isolated event than something that's more systematic or could trigger some contagion effects. What's keeping high yield corporate bond spreads very tight? One is very low volatility in the stock market. Now, that, of course, that's notwithstanding the last week or so. Volatility measured by the VIX is right around its historical average, and that typically coincides with a very tight high yield corporate bond spread. The other factor that is helping keep corporate bond spreads high yield very tight, tighter than what we've seen historically, are rising energy prices. And there's a pretty strong correlation, and there's a causal relationship between changes in global energy prices and high yield corporate bond spreads. So given this backdrop, these two key drivers, as long as volatility remains well behaved, which it should once we're on the other side of the debt ceiling, and given our forecast for very strong global GDP growth this year and next year, and the balance between supply and demand favoring demand for oil, we expect a steady increase in global oil prices through the rest of this year and into next. Therefore, high yield corporate bond spreads should remain tight in the near term. Once we get into the second half of next year, we'll start to see high yield corporate bond spreads begin to rise, and that's going to coincide with just broader financial market conditions. We're going to have the 10-year Treasury yield steadily rising. There's going to be more hints by the Federal Reserve that it's getting ready to raise the Fed funds rate for the first time. The other thing is we'll probably get an early indication that high yield corporate bond spreads are going to start to increase by looking at the U.S. 1-year EDF. And EDF is, I apologize, to sort of lay this out earlier. The EDF is estimated default frequency. It's a very timely, it's a real-time measure of market risk, business risk among corporates, and investors' assessment of credit risk. And this tracks the high yield corporate bond spread pretty well. And you can see that both are telling a very similar story. one-year EDF is as low as since the financial crisis. The same with high-yield corporate bond spreads. But I will watch to see if the one-year EDF starts to tick higher, then that would, kind of foreshadow that we may be in the midst of some normalization in the high-yield corporate bond market. But given the backdrop of low interest rates, low volatility, a boatload of liquidity in the market, I think corporate bond spreads will remain very tight, along with a low U.S. corporate EDF for the near term. Now, one thing I want to keep in mind, please kind of keep this chart in the back of your mind, because as we go forward and towards the end of the presentation, when we go through this Armageddon scenario where the debt ceiling is breached, I'm going to bring this chart back to just show you what would occur to both the high-yield corporate bond spread and the one-year EDF under that significant stress scenario. All right, so section 2, and it's probably my favorite section, because anytime I can talk about the Fed, I'm a very happy individual. The 10-year Treasury yield has risen recently. We're closer to 1.2% not that long ago, several weeks ago. And last time I checked earlier today, we're right around 1.5%. And this isn't the start of a taper tantrum. I think the takeaway from this section is that markets are beginning to reassess their expected path for interest rates and the tapering. The Fed's going to avoid another taper tantrum. So the taper tantrum, to refresh everyone's mind, remember, occurred in 2013 when Ben Bernanke, then Fed chair, hinted that the Fed was going to start to reduce its balance sheet during a speech at Jackson Hole in August. That really rattled financial markets because at the time, market investors tied balance sheet policy with interest rate policy. So if the Fed was going to begin to taper soon, that meant higher interest rates are coming. And then going forward over the next couple of months, the 10-year Treasury yield rose by roughly 100 basis points. And that's the so-called taper tantrum. And leading up to this tapering process, there was still some concerns, some lingering concerns that we could see another response similar to 2013, which caused financial market conditions to tighten. But if you go back and look at the high yield corporate bond spread and the U.S. EDF, they continue to improve. So that market angst about Fed tapering and possible rate hikes, that really never led through into broader capital market conditions. And I think that's a good lesson to remember, particularly given that the Fed, and what I'm showing you here on this chart, is potential paths for the Fed's tapering of this $120 billion in monthly assets. The green, blue, dark blue, and orange are paths that were, I assume, pre-September FOMC meeting. And some paths were, if the Fed wanted to go slow and steady, if they want to be more aggressive. At the September meeting, we got a very clear indication of what the Fed's plan is. Now, the timing of when they start this is still a little bit unclear, but it's this tapering process is going to be more aggressive than I think the market anticipated. Before the FOMC meeting, if you looked at the New York Fed survey of primary dealers, they were expecting 15 billion reduction in monthly asset purchases per FOMC meeting. Now, the Fed plan is an 8-month tapering process. They want this wrapped up by roughly mid-next year. So that means 15 billion per month, probably starting in December. If we get a very strong employment number, a drop in the unemployment rate, stronger wage growth on Friday when we get the December data, then maybe a November tapering is on the table. But as of now, I think the Fed's going to want to be cautious. Make sure we get through the debt ceiling. Make sure there's not any concerns for a partial government shutdown in early December. And then I think the Fed will follow through with tapering at the December meeting. But the key takeaway, no taper tantrum. Fed Chair Powell has divorced interest rate policy from balance sheet policy, And that has limited the increase in long-term rates, given that the Fed has sent its advance notice that the tapering is coming. So what's driving long-term rates higher? This chart decomposes the 10-year Treasury yield into its three main components. The green line is inflation expectations. Right, so this is long-term inflation expectations, market-based measures. The blue line, the dark blue line, is the expected path of real short-term rates. So another way of interpreting this is what's the expected path of the Fed funds rate adjusted for inflation. And then the light blue line is the term premium, and this is the extra compensation investors need to hold long-term rates versus short-term rates. And what's driven the 10-year Treasury yield higher recently is an increase in the term premium. And that is where the Fed's monthly asset purchase, that $120 billion in treasuries and mortgage-backed securities, that's the primary way it lowers long-term rates, is by depressing the term premium. Now that the Fed has signaled that they're going to start walking back some of these purchases and dialing it back, you've seen the term premium start to creep higher. Still negative, which historically is normal when the Fed's doing quantitative easing. But it's climbing, and that's contributed roughly half of the increase in the 10-year Treasury yield from its recent lows. The other thing that's driving it higher is markets are reassessing their expectations of the path of the Fed funds rate, and you can see that pretty clear in this slide. The dark blue line is the market implied path for the Fed funds rate out 3 years. That was in January of this year. The light blue line was the expectations before the last FOMC meeting, and the green line is the current market pricing. And you can see just over time, we've gradually ratcheted higher their expectations of the amount of tightening that will occur during the upcoming tightening cycle. Now, the timing of when this begins, the Fed's kind of divided. Roughly half FOMC participants expect late 2022. The other half expects sometime in 2023. Our baseline forecast is for the first rate hike to occur in early 2023, and we have a more aggressive tightening cycle than that implied by market expectations. I think this is where if we do get an adjustment in long-term rates more quickly than what's penciled into our baseline, which is just a steady, gradual increase in long-term rates over the next few years until they hit their equilibrium, an equilibrium 10-year Treasury yield by 3.75% to 4%. That increase should be orderly unless the markets suddenly reassess, the path of the Fed funds rate. The path implied by markets currently is pretty benign. As you can see, it's a little over 100 basis points in tightening over 3 years. Given the backdrop of very strong GDP growth, inflation that is going to decelerate back towards the Fed's target, but it may stick around a little bit longer given the global supply constraints. It's difficult to see how the Fed could raise or normalize interest rates along the path of what markets are expecting. So in the end, we're likely going to continue to see markets ratchet up their expectations for the amount of tightening that will occur during this tightening cycle, and how aggressive the Fed will be. This sudden readjustment of market expectations that can feed into broader financial market conditions. You can look back at the periods where the market suddenly reassessed their expectations for Fed tightening, either tightening or suddenly expecting Fed rate cuts. And you can see the response in corporate bond spreads in the EDF, because particularly for those industries that are interest rate sensitive. So overall, higher rates are coming, but it's not, the Fed funds rate is unlikely. The Fed's not going to really begin tightening monetary policy until the job market is back to full employment. And economists, they throw out all these different parameters of what best measures full employment. And I think the best one is the prime age employment to population ratio. And an economy at full employment, that ratio is 80%. Currently, we're at 70%. And this this kind of moves like a large iceberg. It doesn't improve rapidly over a few months. It takes time, but by this time or late next year, we should have an economy that is very, very close, if not at full employment, and that's the last criteria that the Fed can check off and begin to acknowledge that they're going to start tightening monetary policy. That communication is very important around periods of changes in monetary policy, and that's why you see financial market conditions. You can see the EDF, there can be some wiggles around Fed communication with regards to the tightening cycle. The other thing I wanted to point out is that the rise in the 10-year Treasury yield is justified. What this chart is showing you is the actual 10-year Treasury yield, which is the green line, and the model implied 10-year Treasury yield. The way to think of the model implied 10-year Treasury yield is its economic fair value. So we modeled the 10-year Treasury yield using 5 economic variables, and we use this as kind of a measure of is the 10-year Treasury yield above what the economy is telling it to be, or too low. And if you go back to the taper tantrum, you saw the 10-year Treasury yield really jumped above its equilibrium value. Currently, it's still a little bit below, so there's some room for the 10-year Treasury yield to rise. Currently, the equilibrium 10-year Treasury yield is closer to 1.56, or about 6 basis points below what the equilibrium model would imply. But as you can see, we don't have a 10-year Treasury yield that's way out of whack with the economy's underlying fundamentals, and that's another reason so far that I think we've avoided the taper tantrum. So this section we're going to turn, so it's mostly good news on the Fed front. They're going to pull off tapering without a tantrum. Next year, our focus will start to shift, and market's focus will start to shift towards the timing of the first rate hike. So there could be some hiccups here and there. You could see some response in corporate bond spreads in the EDF around periods where markets are kind of uncertain about the timing or the pace of tightening cycle. This section, we're going to focus more on something that is going to be a problem for the next couple of weeks. And we have to think about the unthinkable, and that's the debt ceiling. And so everyone's on the same page. We've seen this movie before, and I think why we haven't seen an enormous response in financial markets yet, and we'll go through this dashboard shortly, is that they know how the movie ends. And that, at the 11th hour, lawmakers will raise the debt ceiling, and that will kind of remove this enormous weight on financial markets. And what this chart's showing you is just periods where the debt ceiling has been raised or suspended. And our working assumption is that the drop dead date, we calculate this based on monthly Treasury statements, is that the Treasury will run out of cash right around October 18th. Now, Treasury Secretary Janet Yellen warned that it could be a couple of days earlier. It could be October 16th. So they're right in line with what we're estimating. But that's going to be the period that everyone has circled. And looking back, at least historically, markets begin to get a little bit more concerned the closer and closer we get to this drop dead date. And a good early warning indication is the 1-year U.S. corporate EDF. Right now, that's sending a signal that no significant concern yet, but we're still 10 days away. Leading up to the last few nasty debt ceiling spikes, which were in 2011 and 2013, when we had divided government. The 1-year EDF did start to tick up, a few days before the drop dead date. Eventually, of course, the debt ceiling was raised, and then you saw, a big sigh of relief in financial markets. The 1-year EDF fell back down. Volatility in the stock market decreased, and things kind of, returned to normal in many of those instances, except for when the European sovereign debt crisis began to hit. So I want to make sure we leave enough time for questions, but this slide is just kind of reinforcing what our drop dead date is and how we calculate it. We look at the projected treasury payments and tax receipts. If this drop dead date can change, it could be sooner, it could be a little bit later, and that's why kind of my little dashboard of gauging financial markets concerns, I think is helpful in assessing the amount of credit risk that is being perceived and angst in financial markets surrounding the prospects of the debt ceiling not being raised. There are economic costs of the debt ceiling, even though we all know it's going to get increased. The political and economic costs are enormous. Therefore, I think lawmakers know that they need to raise the debt ceiling. But even the battles, the arguments back and forth about the debt ceiling, discussion that some lawmakers won't support raising it, that has economic costs. We're already seeing that chink that normally occurs in the Treasury bill curve. And we're also seeing consumers respond. They see the headlines, they read it in the newspaper, they see it on TV, these concerns about the debt ceiling. And you've seen consumer confidence respond. Now, a good chunk of this decline that you see in the blue line, which is the Consumer Confidence Index from the University of Michigan, that's COVID related. That coincided with the recent surge in daily confirmed COVID cases, and that really weighed heavily on measures of consumer confidence. So far, so good on this debt ceiling study. If you look at Google Trends and search intensity for government shutdown or debt ceiling, it hasn't really increased significantly. But when you see these big spikes back in 2011, 2013, that was roughly a week before the debt ceiling. So something to watch next week is this registering in consumers' minds? Are they really nervous? And sentiment, again, is fragile, and it can shift very, very quickly. But, as we're having our conversation today, so far, business confidence remains solid. Consumer confidence got crushed by the recent wave of COVID-19, but it's showing signs of stabilizing, and it doesn't seem like the debt ceiling is having an enormous effect yet on the collective psyche. Where it is having some effect is in financial markets. Investors have taken notice. And what I'll show you here is the learning from past experiences. Here's the one-year EDF leading up to, in years that we had these nasty debt ceiling fights in 2011 and 2013. And you can see these little increases in the blue line right around September that in 2011. Even though we had a very significant debt ceiling fight in 2013, there wasn't a lot of indication. And of course, this is the monthly average. So if you look at the daily, you'll see some volatility in the series. 2013's episode was worse than 2011 because it also coincided with a government shutdown. And that was the concern this time around, is that we could have a repeat of that, a government shutdown that overlaps with a debt ceiling fight. Fortunately, lawmakers kicked the can down the road. They didn't kick it too far. They have until December 3rd, I believe, to pass budget resolution where it funds the government for the next fiscal year, or there will be a partial government shutdown. But when you look at the EDF around instances of government shutdowns with a debt ceiling, government shutdowns without a debt ceiling, there's not an enormous amount of angst or increase in the EDF. And that's a good leading indicator or signal that markets view these battles as temporary, that they're going to get resolved, and there's no long-term damage to either financial markets or the economy from a partial government shutdown or a nasty debt ceiling fight. Because again, getting back to the movie analogy, we've all seen the movie before. We know how it ends. But if there's any prospect that the ending of this movie is different, you will start to see an immediate response in our measures of our EDF measures the Treasury bill curve, consumer confidence, business confidence, and investor sentiment. It would be a sudden moment. It could be similar to what you saw around TARP, the Troubled Asset Relief Program. If everyone recalls, we're watching TV when they're voting, lawmakers are voting whether or not to pass the initial version of TARP. They turned it down, and all hell broke loose. The stock market plunged. You got a sudden tightening financial market conditions, but that gave lawmakers their aha moment, and they quickly reversed course and passed TARP. We don't want to do that with the debt ceiling because the economic cost would be much more significant. You could have a TARP-light moment if lawmakers temporarily breach the debt ceiling for a day or two, and that would still have some economic costs. You see it reflected in the EDS and the high-yield corporate bond spreads, and there's nowhere to hide really on the credit ladder. There will be a response throughout the corporate credit ladder. So the things looking at, why I don't anticipate a enormous increase this time around in either the EDS or the high yield bond spread, all based on past experience. We seem to digest them fairly well. 2011, you see the high yield corporate bond spread begin to increase, but all that increase was after the debt ceiling. That's nothing debt ceiling related. That was more attributed to the slowing in the European economy, concerns about sovereign debt at that time around. Leading up to the debt ceiling, there was a very, very muted response. And I think that's what the most likely scenario, our baseline forecast, is that you don't see a lot of movement in the EDF or the high yield corporate bond spread. But these past experiences, it doesn't mean that they'll definitely be repeated. History doesn't always repeat itself. And if you do begin to see indications that the one-year EDF is starting to move, that would raise a red flag. That's an early warning that this time may not be different, and that we could have some more stress in the corporate credit markets, in financial markets, and the bond markets than we've had in past experiences with the debt ceiling. One area that you're seeing a response is in the forward Treasury bill yield. Again, I'm comparing 2011 to 2013. So far, the increase would be less than what we saw in either 2011 or 2013. And why the response in the Treasury, the forward Treasury yield in 2013 is much more significant than what we saw in 2011 is that in 2013 there was the government shutdown occurred before the debt ceiling. So you already had markets beginning to price in a government shutdown on top of or coinciding with a debt ceiling increase that's needed. So you saw a much earlier response where the more typical response would be in 2011, 3 days out, you start to see a big increase a noticeable increase in the forward Treasury bill yield. Currently, if you look at the Treasury bill maturing right around the drop dead date, October 16th, 17th, 18th, that's risen, and it's higher than bills that are maturing either before the debt ceiling expiration or shortly after. And that normal kink in the Treasury bill curve is something that we would expect. There's a little angst in the bond market, not a ton, about the debt ceiling. So that is something we're keeping a close eye on. So, as we draw closer, my checklist is, watch the EDF, watch the Treasury bill curve, the volatility in the VIX, the stock market, investor sentiment, and also consumer sentiment, because there's not just the financial cost of this angst around the debt ceiling. Consumers may begin to respond because, again, sentiment is fragile. The collective psyche typically is really, really important around turning points. And if we begin to be frayed because of the debt ceiling, then that would have economic implications. All right, so the next few slides are going to be, I'm not trying to scare everyone, but we're going to hope for the best and forecast for the worst. So one scenario that we ran through our U.S. macro model is one where we have the government fails to raise the debt ceiling, and It's not just a temporary one. I think there was one that occurred for a day back in the 1970s. This is more an extended one that lasts into November, so a little bit more, right around a month. The Treasury debt ceiling is raised. So we ran that scenario through our macro model, and an extended breach of the debt ceiling would cause a recession very similar to the Great Recession. So that's roughly a 4% peak to trough decline in GDP, a 6 million increase in the number of people unemployed, an unemployment rate near 9%, a significant drop in equity prices, and so we ran that through, and I wanted to see what that would imply for the EDF and the high yield corporate bond spread. We don't forecast the 1-year EDF, but we'll come back to that in a second. The green line is the Armageddon scenario. So again, that's that extended breach of the debt ceiling, and you see instantly there's a significant widening in the high yield corporate bond spread. But that would slam the brakes on corporate bond issuance. That would instantly start raising credit concerns. Typically, when high yield corporate bond spread seems to increase, then that kind of foreshadows more trouble ahead in the corporate bond market and increased concerns about credit risk. The blue line, what our baseline forecast is, and that's the most likely scenario. So the Armageddon scenario, that's out on the tail. That's something that we got to think about, but it's not the most likely scenario. The most likely scenario is the blue line. But if we do breach the debt ceiling, this is what the response in the high yield corporate bond market would be. And based on its relationship with the 1-year EDF, U.S. EDF, we would see the U.S. EDF almost triple what it is today. So right now, it's low, but if we have a breach of the debt ceiling, it would almost triple. So that's kind of putting everything into perspective. And again, we would likely see the EDF increase, a little bit before the high yield corporate bond spread would begin to raise the red flags or sound the alarms. And then I'll wrap up with this slide. Even though the last one focused on the high yield corporate bond market, there's nowhere to hide if we breach the debt ceiling for an extended period of time. And this one is showing you the Moody's intermediate bond yield average. This is all investment grade. So you would see yields start to really increase if we breach the debt ceiling. Let me see. Sorry, my dog's going crazy. So again, just to reiterate that, and this is what I promised you, I'd end on a good note. Even though there's potential for some angst and, there could be some bumps along the road in financial markets over the next few weeks, underlying economic conditions, financial market conditions are all still very favorable. We'll start to see default rates begin to rise. 1 year, you start to see some increases in EDS among industries that are very sensitive to interest rates. But when you take a step back, conditions are still going to remain very strong. We're in the early stages of what should be a long economic expansion. And I know we talked about some dark scenarios. They're very unlikely. They're on the far tail of the distribution of possible outcomes. Our working assumption is that this is the same movie. We know how it's going to end. In the 11th hour, we'll raise the debt ceiling, and we'll avoid having to go down this very, very dark path, which I think lawmakers are very aware exists, that the economic costs of not raising the debt ceiling are enormous, and the political costs are enormous. And that's the most likely catalyst for justifying them raising the debt ceiling. So we're past the best times, but the next few years are still going to be very good times for corporates. The amount of liquidity in financial markets is a boatload. Leverage is a concern, but we're still going to be in a very low interest rate environment for the next couple of years. and unless interest rates adjust abruptly, there's not a lot of concern that the amount of corporate debt that has increased recently is going to have any significant impact on EDS or broader financial market conditions, and by extension, the U.S. economy. So with that, I'd be more than happy to answer any of your questions.
Great, thanks, Ryan. We've had a couple of questions come in already, but please feel free to submit more through the Q&A tool. Let's jump in. Okay, Ryan, so do any of your scenarios and outlooks for debt and rates take a view of crowding out from government spending?
It does. So the model is designed in a way that it will factor in crowding out from expansion fiscal stimulus. So our baseline forecast assumes roughly $2.5–3 trillion in additional government spending, and that's broken up between infrastructure spending and then Biden's Build Back Better agenda. So when we add it all up, it's going to be about $2.5–3 trillion. We likely might scale that back a little bit, just given what's going on in D.C. and the support, where the support lies for a bill is likely somewhere in between 1.5 and 3.5 trillion. So it may just split the difference. But when we run that through our macro model, it does factor in what the impact on crowding out of private sector investment, what the impact on interest rates is going to be. So our models do capture that. So the baseline forecast that I showed you, the blue lines in each of the last two slides, does incorporate any adverse effects of the significant increase in fiscal spending that is coming.
Here's one about inflation. So I've read that indicators like inflation are not as transitory as initially thought. Do you see data supporting that inflation is now more embedded than 3 or 6 months ago?
Inflation is a hot topic, and it's on everyone's mind. I'm still of the view that it's transitory, and let me lay out why. If you look at the breadth of changes in consumer prices and producer prices, it's fairly narrow, and it's isolated to areas that are tied to the reopening of the economy, which include lodging away from home, so hotels, motels, rental cars, these areas, restaurants. These are areas that got hit very hard by the pandemic, where they shut down the economy. And now that we're in the midst the later stages of the reopening of the economy, you're seeing price pressures there really emerge. But over the last few months, they're starting to fade. The other area, which has contributed the most to the acceleration in consumer prices recently, are new and used car prices. And this is tied back to the global semiconductor shortage. And this is where we could see some lingering in inflationary pressures because global supply chains are still very, very disrupted. Recently, we created a global supply chain stress index for the U.S. And it basically takes into consideration all measures of supply chain stress. So supplier delivery times, container traffic, cost of shipping. And we just combine them, create an index, and it's showing no signs of easing. It's still extremely elevated. And that kind of lends support the idea that this transitory inflation could persist a little bit longer, but in the end, as long as inflation gets back to the Fed's 2% objective, which likely will occur second half of next year, I think we'll look back and economists will judge this period as inflation, a transitory period of inflation. The key is really what I'm paying attention to are nominal wage growth, which is solid, but it's not strong enough to set into motion a wage price spiral, which would be a necessary condition to create inflation that is sustained around 4 or 5%. That's unlikely going to occur. And I'm also watching market-based measures of inflation expectations. So inflation swaps, five-year forward. Because as long as inflation expectations remain anchored, it's unlikely that this transitory period of inflation turns into anything worse. If you go back to the 1970s, early 1980s, when we had that period of stagflation, which is high unemployment, high inflation, the reason that occurred is that the Fed ignored inflation expectations. They became disanchored or unanchored, and that's kind of set in this wage price spiral that occurred that drove inflation to rates that we haven't seen in some time. So I know it's uncomfortable now. The inflation's cutting into people's spending power, but with corporate profit margins wide, meaning that they can absorb some of these higher input costs, inflation expectations anchored, nominal wage growth decent but not robust, and the fading effect of the reopening of the economy, along with hopefully some improvement in supply chains. And our baseline forecast is that the supply chain issues aren't completely resolved until at the earliest mid next year. So we could see some inflationary pressures linger into next year, but all told, we'll start to see more modest rates of inflation over the next 6 to 9 months.
What factors does the EDF include to make a forecast, and how accurate is it?
So we don't directly forecast, and this is from the economics team, we don't forecast the EDF. How I that chart that shows you the relationship between the high yield corporate bond spread and the EDF, you can use that as to create a regression or a forecast of the EDF, because there is a very strong correlation and a causal relationship between the two, and you can just back out a forecast for the EDF using the high yield corporate bond spread. It's not perfect, but the relationship is strong enough where it gives you a good idea, probably with not enormous confidence interval around a projection for the 1-year EDF.
Are Delta and COVID still important for the economic outlook?
Unfortunately, yes. The economy, even financial markets, both are tied to the hip with COVID. You saw with the Delta variant, the wave of recent confirmed cases, that really fit into the economy much more than we had anticipated. And as a result, we reduced our GDP growth forecast for this year from 6.5% to 6%. And most of that is attributed to this wave of COVID-19. It had an impact on the job market, impact consumer spending, it shifted spending back towards goods, away from services, reduced travel, a lot of the very high frequency data that, I pay attention to, Google mobility, number of people passing through TSA checkpoints, all deteriorated, in the midst of this wave of COVID-19. So unfortunately, until we're on the other side of the pandemic, the economy's near-term prospects are still tightly tied to the hip with the pandemic.
Okay, I think we'll end on this question. Do you think there will be a $1 trillion coin?
This is a great question to end on. So I hesitate a little bit, because if we get to the 11th hour and there are no signs that the debt ceiling is going to be raised, I think the Democrats and the Republicans will, if they're going back and forth, no one's going to bend. I think the Democrats know the economic and political costs of not raising the debt ceiling, and that's when they would go and pull a Hail Mary and print the $1 trillion coin. Now, I don't know whose face they would put on it. I think that's up for debate, but this platinum coin, this $1 trillion coin, would be the last-ditch effort to avoid this cataclysmic event of not raising the debt ceiling. I don't think we'll get there. I think they'll raise the debt ceiling through their normal negotiations, comes down to the last minute. But why that Armageddon scenario is so far out on the tail end of the distribution is that there is that kind of Hail Mary of printing the $1 trillion coin just in case that coin is not raised. Because I'd rather have them print the $1 trillion coin than breach the debt ceiling.